participating in this first panel. The authors are who I see most. I see Shekhar Tomar from ISB is here, and Sanchit Arora from Ernst & Young. And the third author is Leslie Juranovic. Hopefully I'm pronouncing that correctly. And our commenters in the same order are Vimal Balasubramaniam, Josh, who's at Queen Mary in University of London, Josh Fellman at J&H Consulting, and Pab Jyoti Kasthira. Hopefully I'm pronouncing that correctly as well. Maybe we'll just wait a few minutes before starting. We don't have to wait until 6:15 dot, but maybe we'll give oh, and yes, the just in case you haven't seen in the chat, this session is going to be recorded, just so you know. But what do we think? Should we go ahead and get started now, or should we wait?
No, I think that if you have your first paper presenter and discussant, we can start with everybody's permission. We have a good size of number of participants here. One thing I did want to suggest is that usually we have the chat box. Everybody can post questions and comments, even as the paper is being presented. If there's something urgent, Zoom allows a feature of raising your hand. So if you have a clarificatory question, I suspect that Adam, your call, but they can either raise their hand and perhaps you can call on them to ask the question. But we would request that if you raise your hand only if you have a clarificatory question, or as I said, you can post your question in the chat box, and we will take it at the end of the discussant's presentation when the floor is open to general questions.
Super. So why don't we go ahead and get started, and I will keep an eye on the chat for the discussion afterwards. Keep an eye on the chat, and people may want to ask questions live as well. So with that, Shekhar, are you all set?
Yeah. Yeah, I can
Great.
share my screen. Perfect.
Great.
I guess you can see it now.
Yes.
Perfect. So should I get started then? I guess so. Okay. Thank you, everyone. Thanks for having the paper on the conference. It's always a pleasure to present at IGIDR and other conferences. So what I'm presenting today here is the Does Inflation Targeting Help Information Transmission? It's a joint paper with Satadru, who is at RBI, Jay, who is at IMF, and of course, I'm Shekhar Tomar. So the question that we are asking in this paper is we want to understand the impact of inflation targeting on the market participant behavior. And the reason we are asking this question is because inflation targeting is increasingly being adopted by central banks around the world. And I mean, beginning since 1989, when New Zealand was the first country which adopted this policy. Since then, a lot of countries have adopted. And even in the last 1 decade, there are like 10 to 15 new countries which have adopted it. And mostly it's emerging market countries, but we haven't had a full study on how this inflation targeting framework works. And does it really have any impact on the market? So I'm not going to talk about its impact on the inflation directly, but I'm going to look on the other side, which is, does it really improve information transmission from the central bank to the market? And one way that inflation targeting really works is it standardizes the date and format of central bank communication. And so the central bank has to announce the policy, but at the same time, it also has to provide a statement or a document explaining to everyone else in the market why they took a certain decision. So from that perspective, it really improves the transparency and accountability on the central bank part. Now, given that inflation target is a publicly announced information and the central bank also provides its rationale behind taking a certain decision, it would lead to better inference by market participants. And the reason is that you know the target and you know the policy decision of the banks. So then you can invert back and understand the additional information that the central bank is providing to the market. And so that's the idea here. And we want to look at and ask this question, does inflation targeting really improve information transmission? And the way we do that is by utilizing a hard switch to inflation targeting by India in 2015. So it's one of the major emerging market countries which adopted inflation targeting in the last 1 decade. So we use that as our event study, or we use the case of India as our event study. And the idea is that we want to test how does monetary policy surprises have any impact on market volatility. And so it again goes back to this idea that market participants would be able to invert back the information given the policy decision and the target of the bank, and use that additional information to adjust their portfolio in the market. And so on average, if the central bank is announcing a policy, but that is something which is on the expected line, it shouldn't move the market. And if it doesn't move the market, then there shouldn't be any change in market volatility either. The impact should arise when there is a monetary policy surprise, and then we want to look at whether the market volatility goes up or not. And so in this paper, we focus both on bond and equity market. But just to put a footnote here is that we are looking at the change after the inflation targeting regime was adopted. So it's not just looking at how does monetary policy surprises impact the market volatility, which has been done by a lot of other papers as well previously. But in this case, we are specifically looking at, did it improve or did it really change anything after the inflation targeting regime adoption? Now, in terms of main results, we do not find any change in market volatility after inflation targeting was adopted by India. Now that is very interesting to know, but then we also go a little bit deeper and ask, okay, we do not see any change after the adoption of inflation targeting. So what's happening? Is it due to some kind of financial frictions in the market? And we are going to show that no, that's not the case. And then the second and the more important point is we also show that it's not really about how the Central Bank of India, which is the RBI, that there was no change in the communication by the central bank. So when we look at emerging market economies, generally there might be some doubt on whether the reform is real or is it just on paper. And so we really wanted to test, okay, if RBI announced and changed this policy, did it also follow it up by actual change in its communication? And so we find that, yes, there was change in communication, but the focus was more on the inflation side of it and not on the growth side. And so maybe that's one of the reasons why market doesn't react, or the market reaction doesn't change even after the adoption of IT. Now, as I said at the beginning, there has been a big literature on information released by the central bank and the market reaction. So we are adding to all of those literature. Also, some people have looked at emerging market economies, how emerging market central bank can influence the market reaction. And as I said before, there is this set of papers, but no one has looked at explicitly in terms of the changes after the inflation targeting regime. So that's where the paper kind of lies. And then the last part is about the central bank communication, which is looking at the actual statements, actual communication by the central bank, and look at the text to see whether anything fundamentally changed after the adoption of IT or not. So that's the last part of it. Before I go to the main empirical specification, just to provide an institutional background, the main monetary policy framework was signed between the Reserve Bank of India and the Government of India in 2015. And so we divide our data into two periods, which we call BIT and BIT and PIT. So before inflation targeting and after inflation targeting. Some of the major differences between the BIT and the PIT period are that the RBI has an explicit inflation target of 4% with a error band of 2% around that, just so that the central bank can accommodate information about growth and also support on that direction. One important difference is that the policy decisions are now taken on single pre-announced date. So we only include pre-announced date both in the BIT and the PIT period. But the slight difference is that in the PIT period, which is a post-inflation targeting, the calendar is announced at the beginning of the year. In the BIT period, the RBI would announce at the end of the policy that the next policy would happen in 2 months or 3 months. So that's small change. It's not that we are taking unannounced policy changes. So everything is pre-announced, but the calendar was not precise in the BIT period. And then finally, RBI explains each of its policy stands in a much more publicized and standardized manner. In terms of the main policy instrument, repo rate is the main policy instrument, which continues to be the main instrument for the RBI. Now, the important point is, okay, we see that RBI adopted this policy. Did it have any impact on the market at all or not? And so the first thing we look at is some of the most informed players in the market, which are the professional forecasters. And we look at whether the adoption of inflation targeting had an impact on how these professional forecasters provide their forecast. And so RBI does this survey, and so we are just using 2 of the moments from there, and we look at the absolute mean forecast error. So what is the mean forecast error for these professional forecasters, and similarly the median. And we find that in both cases, the forecast error has gone down in terms of the repo rate by these professional forecasters. So it's not that it's only on paper. At least the most informed agents in the economy were paying attention to it, and their forecast improved. But there's nothing causal here, and there might be other factors as well why this performance improved. Maybe there was not so much uncertainty in the later period. So having said that, but we'll talk about this a little bit later, but at least on paper, it seems like something changed after the adoption of inflation targeting. In terms of the market data, we are looking at 10-year benchmark GSEC and Nifty 50 index. So we are looking at both the bond market and the stock market. And then I mentioned something at the beginning about measuring the surprise. So to measure the surprise, we use the 1-month OIS rate in India. We have a total of around 2,000 business days, out of which 1,000 lie in the BIT period and around 1,000 in the post-inflation targeting period, some 32 policy days in the BIT period, and 28 in the post period. In terms of the empirical strategy, what we do is we use event study approach and we check the market activity around the policy days. Since we are looking at volatility, we use a eGuards model, and there is the full model which is in the background, but I want to focus on this one specific equation which I have over here, which essentially captures this idea how the volatility changes around the policy days. So just to simplify things, let's look at the first 3 terms. So what these capture is each of these is a dummy variable. So IT MPC minus is the day before the policy announcement. So it's day -1 if you might want to call it. The second one is IT MPC. So it's on the day of the policy announcement. And then this third guy is IT MPC plus, which is 1 day after the policy announcement. So let's take a step back. If the announcement by the RBI really increases the volatility, then we would expect that this delta 2 should be positive and significant. On average, if on policy days there is more volatility, then that's what should happen. Similarly, we can also interpret delta 1 and delta 3. The other important coefficient is on this ITS, or the delta 4 coefficient. It captures the surprise element of the policy. So on average, there's no reason to believe that RBI announces something and the market would react. The market should only react if RBI is providing some additional information which was not there with the market. And that's where this IST term comes in, and it's captured from the change in the OIS on the day of the policy and the 1 day before. So it's essentially capturing how much the OIS moves on the day of the on the day of the policy making. And then we give it a dummy variable 1 if it's above a certain threshold. So in this case, we are taking, if it's above the 80 percentile change, then it takes a value equal to 1. Okay, so now let's put everything together. So we have looked at these specific delta 1, delta 2, delta 3, and delta 4. But the other important variables are, did it really change after the inflation targeting? And so that's why we have these other 4 sets of variables, gamma 1 to gamma 4, which are again based on the same dummy variables, but on top we interacted with the dummy variable for post-inflation targeting period. So this dummy at the beginning is capturing whether we are in a period after the inflation targeting period. And so if any of these, let's say, for example, gamma 2 is positive, it means that over and above the impact of delta 2, there is some additional impact in the PIT period. And so that's what we are going to look at. So let's look at the first market, which is the bond market. And let's look at the most simple model. We don't complicate it by looking at the post-inflation targeting period. Let's just look at the first part. And I'm not going over these mu1, mu2, and mu3, which is just RBI also had some 2-day policies. So that's an additional layer of complication, which we take care of. But effectively, let's look at the most important coefficient, which is delta 2. So if we look at this model 1, what do we see? Is that the day of policy increases the volatility in the market, increases the volatility in the bond market. That is without including any other variables. Once you also include the day of surprise policy, which is model 2, in that case, we see that the surprise day actually matters, and that increases the volatility about 0.5 over and above what was there in the previous case. Now, what model 3 does is, we forget about surprise for a while. Let's just see, did post-inflation targeting period increase the volatility or not? And so in this case, we are mainly interested in looking at the variable gamma 2, which is on the day of the policy. And now what we see is that delta 2 is positive, but there is no positive and significant impact on gamma 2. Although gamma 2 is positive, but it's not significant. So the bond market reacts on the day of the policy, but it does not react more in the post-inflation targeting period. Once we include for the surprise element, which is delta 4 and gamma 4, we once again see that delta 4 continues to be positive and significant. So surprise days are really important, but gamma 4 is once again insignificant. So surprise.
Just a 2-minute warning. Sorry.
Okay. So the surprise is not that important in the post period. How about impact on the stock market volatility? And I can go through all these different models, same set of models, but the main key point here is that if you look at gamma 2 and gamma 4, they're always insignificant. So the stock market volatility did not change at all in the post-inflation targeting period. But the other important point is that even delta 2 is not significant to start out with. So in the pre-period, the stock market was not more volatile on the day of the policy, but even in the post-period, post-inflation targeting period, nothing changed. And that's where we should have seen some action if inflation targeting was really providing more information to the market. Now, 2 plausible explanations which we try to look at is, are market frictions really preventing any impact on the stock market volatility? And the answer is no. So the way we test it is we look at, does the Indian stock market react to announcement by the US monetary policy or the Fed announcement? And the answer is that, yes, the market reacts very strongly. And so probably the market friction is not the reason behind this lack of impact. And even otherwise, if we think of the stock market in India, it's fairly deep. And so we should expect them to act on the information if that information really provides some information to the market. And then the second plausible explanation is maybe nothing changed in the RBI communication. It's just a policy which changed on paper. And so the way we do that is we look at RBI communication between the 2 periods. So we look at policy statements by the RBI between these 2 periods. So we do text analysis of RBI policy statements, and we look at the focus. We look at the focus of the RBI on inflation and growth in these statements. while they're explaining their rationale for the decision making. And so the way we do that is by doing some topic modeling, by using a LD algorithm, which basically allows us to classify text and provide importance to different topics within a given policy statements. And so what do we find? So what we have here is the topic importance of growth and inflation. And so the algorithm allows us to normalize the importance of all topics within a given statement between 0 and 1. And so what we have here is that if you see closely, the inflation used to fluctuate a bit. The focus of RBI on inflation used to fluctuate a bit in the pre-inflation targeting period. But if you see in the post period, there's a very strong focus on the inflation topic. How about growth? They stopped focusing on growth at all immediately after the inflation targeting period, but towards the end of the period that we are considering, the focus on growth also continued to go up. And so what this tells us is that there was definitely a change in the communication on the RBI part, but it mainly focused on the inflation side of the economy and not on the growth side. And maybe that is one of the reasons why we don't see any action on the market volatility side. So I'll conclude here. Basically, what we learn is that the switch to inflation targeting did not really improve information transmission. We find exactly the same impact on the market volatility. The surprising part is that the stock market, which is one of the more deeper markets in India, there is no change in the volatility there, even after the policy announcements. Now, why is this lack of impact? It's not because of market frictions. It's not because RBI did not change its communication at all. However, we see that there is a more focus on inflation rather than growth. So maybe that's one of the reasons. And then, of course, there are some other factors which we can't explain in this study, which is that maybe there is a general fiscal dominance in the market. And maybe that's the reason why the Indian markets don't take information from the RBI very seriously.
Super, thanks so much. Over to you, Vimal.
Thank you. Just sharing my screen. Does it work, Adam? Can you see all right? Okay. Yeah. Thank you so much for that very clear presentation, Shekhar. I'm just going to do a quick overview of your presentation and then move to a few comments on the paper. The broad story is that the question of what inflation targeting does to information transmission is an important question. And we have an interesting setting in India where India formally moved into an IT framework in 2015. And since IT framework, which is inflation targeting, has been touted to be useful to clearly communicate with markets and clarify what the central bank's objectives are, we should find some relationship in terms of how market players react to central bank communications when inflation targeting framework was adopted. The authors use an event study designed to study this and find two very interesting results. The first thing is that they find no effect on bond market trading volume or volatility that is any different from what it used to be before the inflation targeting era. And they find that there is absolutely no relationship to equity return volatility before or after inflation targeting was adopted. And the argument that the authors use is that the monetary policy has actually been informative about inflation, but not about growth outlooks or risks. And the textual analysis using linear discriminant analysis supports this view. Now, I just want to step back a bit and understand what my priors are going to be about theoretically about inflation targeting information and bond market volatility. Bond prices fluctuate when interest rates change, okay? And that is going to be the case because the extent of volatility relies on the maturity, the yield, and the credit rating of the issuer. And if we were to look at a 10-year bond, because it's slightly on the longer end of the maturity scale, you should find a relationship when the lower end of the yield curve changes. You should find some change with the higher end. Now, clearly, post-IT, the question is whether there's going to be any incremental surprises that is going to be available than it was before IT for bond market players to react to it. So having a clear objective function would allow the bond traders to hedge in the right direction. It allows traders to form expectations of where the yield curve is going to be going forward. Now, if IT anchors their expectations, then there should be a case where you would find that the bond market volatility is going to be much lower. Not sure I have a prior, although on the bond market volume, unless you have a story about deepening markets and trust in markets and so on and so forth, because there's greater certainty with what the yield curve is going to look like. But given this prior, if IT, sorry, I meant it to be cap IT, does not affect volatility, then the relevant question is whether the inflation expectations of these traders are well anchored in India to begin with, right? And now let's look at the stock market side. What are my theoretical priors? Now, stock market volatility, we can always decompose it into two components. We can think about the discount rate news in the market volatility, and we can think about the cash flow news in the market volatility. And the authors argue that there's little about cash flow news in RBI's MP statements post IT, which is about growth, about risks, and so on and so forth. But if that is the case, what about the discount rate news? So if the inflation targeting framework is robust, then it must affect agents' discount rate over time, because you are changing the short end of the curve based on what the aggregate discount rate in the economy is going to look like. And if it does not, again, the relevant question is whether inflation expectations are well anchored in India. So this helps think about what the mechanism between inflation targeting as a framework being adopted and market volatility, both bond prices as well as stock prices. Now, when it comes to professional forecasters, as Shekhar very clearly showed, there is a substantial reduction in the forecast error in what professional forecasters expect the rate to be post inflation targeting being adopted. But I think the important measure to be using here is think about disagreement about what the future error is going to be. So I would actually have a prior that the variance around forecast expectations across professional forecasters should be smaller ex post inflation targeting framework, because they all have the common anchor. And it would be helpful to think about it in terms of market disagreement, because that's what's going to map to volatility, not levels in terms of what the forecast error differences look like. Second, I want to focus on a recent survey paper by Patnaik and Pandey, which uses the RBI survey on inflation expectations to point to something rather important, which is that the current perception 3 month ahead and 1 year ahead inflation expectations, although you can see that it has come down from what it used to be in 2012 around about time, there's a level shift. Firstly, the level shift happens much before inflation targeting was even introduced to begin with. And second, the level itself is way higher than what the RBI's target band looks like. Okay, so in this case, my question remains as to whether the IT framework by itself is working, because it's about anchoring not just your current inflation expectations, it's all about your 3 month ahead and 1 year ahead expectations. And if it isn't, what is the information that we are transmitting to begin with that we expect bond traders and equity traders to incorporate as information into markets? There's another plausible reason for the findings that the paper has, which is the Monetary Policy Committee sets the policy rate, but are the other things that the RBI doing, are there anything that's changing at the same time? So for example, I found that there are rampant open market operations in the GSEC market, which could potentially tell us that there's something more direct that RBI uses as a tool in the bond market to affect things like volatility and volume that that we need to be cognizant of when we are thinking about IT's impact. Then the targeted long-term repo operations, the unilateral change in the reverse repo rate without the Monetary Policy Committee being involved, and so on and so forth. In which case, if the sanctity of the MPC and the IT framework is questionable, then is it even a surprise that the market haven't reacted that differently than it used to before? So it's more of a de jure versus de facto question. And I think the authors have the ability to be a little more bold in asking this, although one of you is from the RBI. And I think it's also important to establish what IT has changed and what it has not. So I urge you to read this wonderful paper by Mathur and Sengupta last year, which does an NLP and does linguistic and semantic shifts analysis in policy statements, and finds that there has been a drastic shift in the recent past, and that they find lengthier statements to be correlated with higher volatility in equity and currency markets. So, and going further, Patnaik Pandey review the IT framework itself. And I think this paper has the opportunity to put these two together to understand and first establish beyond doubt that what changed across all of RBI's policy actions with IT is documented before we understand what was the new information that we expect the markets to even incorporate. In summary, I think, yeah, almost done, Adam. In summary, I think it's a very important question because we want to understand what really is structurally going to happen when it comes to information processing when you're in an IT framework. And it's a great setting to use to answer this question because we don't get these kind of changes where we have robust data on both sides to answer this question. Very interesting results. It piqued my interest in terms of understanding what exactly I should be expecting. And I just urge the authors to first establish what the inflation targeting framework changed, and it did that, what it did not, in a quantitative fashion for me to understand what is the nature of information we're talking about, and then posit mechanisms through which the authors expect the bond and stock market volatilities to be affected. Because at the moment, I'm a bit unclear as to what my ex-ante expectation should be, because I would have thought that aggregate information about monetary policy works into the equity market through the discount rate channel more than the cash flow news channel. So if I'm wrong about that, that's fine. But I just want to understand what the theoretical priors that I should be working with ought to be. And lastly, I think the authors should be bold and consider that the de jure IT framework announcement and the de facto reality may be completely different. And that's why they don't find effects, as opposed to say that IT itself, I mean, to make a causal statement about IT not having any impacts in the way information processing has been taken into account is going a bit too far given the research design. And perhaps a more relevant question to ask is, if markets could not price this in, does this mean that nothing has changed on ground? And that's probably a far more damning finding, which might not be taken very well, but the authors are in a good place to use that to change policy. So thank you.
Super. So we didn't talk about whether we would give a moment or two for the author to respond. I know I see Ajay has his hand raised. Shekhar, if you have maybe anything essential that you want to say.
So I'll quickly answer the crazy part, which is he really wants me to comment. By the way, thanks, Vimal. Excellent comment. So Satadru is at RBI, but like even with that, like the important point is that we don't include the period after 2019, like after August 2019, when all these open market operations started happening. So Operation Twist. So we don't include that period in our sample. If we do that, then yeah, everything would go out of the window. But even otherwise, I think
probably you should and show that.
Yeah, maybe we should show that, and it would even go away further. I mean, whatever impact they had before. And so I think the main point that you highlight here is, and I totally take it that we are not making this point about the open market operations, but the previous governor, which was Urijit, and also Rajan before that, they were like very careful about establishing the credibility of that. So we include most of that period in our analysis in the post-IT period. And so if we would have seen something, we should have seen by mid 2019. But yeah, you're right, we should include the later period and then everything would go away even more. So that's one part. The other part was on the why should the volatility should be lower. So the main important point, and I don't know if it really comes out of the text or not, is we are looking at the additional information provided by the RBI. So on the surprise days, the volatility should go up. So on average days, maybe not, but it's really those days where the RBI is providing additional new surprise information that the volatility should go up. And that's where we don't see any action happening. Now, coming to your point.
But should I expect it to go up or down? That's my first point.
Yeah, so any additional information which the market does not have, that should allow the market to change its positions. And so that's why the volatility would go up on average.
Okay.
So can I, should we hear questions from the floor or do you?
I'll just answer one last point on the discount rate versus the cash flow side. So I think there is some element of transmission about it, that the transmission from the monetary policy to the bank rates and then to the lending rates is very slow in India, and which is something which the RBI has been trying to change, which hasn't changed. And so maybe there is something out there as well. And so we don't talk about it, but that is potentially the reason why the stock market does not react.
Super, thanks. So I see Ajay has his hand raised and and Parag has a couple of questions in that. So maybe Ajay first, and then you can check the chat, and maybe Parag wants to ask online. Ajay?
Yeah, thanks, Adam. I think this is interesting empirical work, but I think you need to do more work on the larger intellectual framework within which you pose the question and then interpret the results. So as Vimal has already begun, the core problem you need to locate this in is de facto versus de jure. There is a long literature of central banks saying one thing and doing another. So whether you look at exchange rate regimes or you look at inflation targeting, there is a rich literature where our job as academics is to constantly challenge the gap between claims and reality. And over, we find that central banks say one thing and do another. And that's the intellectual framework that should be applied. Second, you said some things like growth objective, and I did not get them at all. I don't see any connection between the weights in a Taylor rule and these findings. The information communication aspects of monetary policy will work under any conceivable weights in a Taylor rule. So whether there's a weightage on inflation and a weightage on growth in a Taylor rule, I don't see how that affects this result. As Vimal, it's good to first pose the question: what is my theory of the world, and what kinds of patterns do I expect to find, and what's my economic argument about it? And then you go into the empirical work. Similarly, you had some throwaway comment about fiscal dominance. I would strongly urge you to keep away from that. This is monetary economics. There is a central bank. It operates a system of fiat money. We're here to study that system of fiat money. So you should not get into these Indian political bureaucratic debates about RBI and Ministry of Finance having a spat. You should stick to the evidence and the intellectual framework of what we are doing in monetary economics.
Thanks, Ajay. I think only on like the second point which you mentioned, of course, the first point is important to place it in the overall literature. On the second point that you made about the growth, that was mainly about the central bank providing information about growth or any surprise information which the market does not have. So the point was not about how much they weigh it, but in terms of how much new information the policy is providing. On the third point, yeah, I mean, it's a debate within the Indian system, but even otherwise, in terms of how the inflation targeting is adopted around the world, and lack of fiscal dominance is posed as one of the pillars that should be there for a better performance of an inflation targeting regime. So I wouldn't say that.
Let me just come back.
Yes,
the location in the literature is this de facto versus de jure. Okay, now you get to the next set of questions. The central bank claims I'm floating and they're actually fixing. And then you might like to wonder, why does the central bank say one thing and do another? Why do central banks routinely have low credibility and don't actually do what they say? That's a second order question. Here, you should just be on a simple problem. You claimed you're doing inflation targeting with the monetary policy framework agreement. After that, the parliament told you to do inflation targeting. Are you doing it? Okay, then a second order question will be, if you're not doing inflation targeting, why are you straying from the mandate of the parliament? That's a second order question. That's a different project. Here, you should stick to the first project.
Thanks.
So there are a couple of so some comments and questions in the chat. Maybe for the questions, I don't know if Parag or Suresh want to
I could,
unmute.
I
Parag?
could ask if, yeah. So I guess I wasn't as I was thinking about the question that I asked, it became much more clearer to me. So I'll go from my second question to the first one. It's like it's very interesting whatever you have found out in terms of having no effect on stock market volatility. So I was trying to relate that to this argument that the NPAs in the banks kind of limit the transmission of the MPC policy rate changes, which I think could also put kind of limits on adjustments in the relative asset returns that could happen. And therefore, I mean, there might be some external process like bank NPAs that could be driving this limited transmission and therefore also stock market volatility or activity on stock markets, which you could probably consider. And I think, I mean, I would like to hear your thoughts on it. And the second, I guess, a little bit in terms of your comment on fiscal dominance, but I guess what I would suggest is, like, I mean, there is a literature about joint determination of fiscal and monetary policy, and how does that interact with inflation targeting framework? So that possibly could be a framework in which you could put your comments about the fiscal policy being the major driver, and how under an inflation targeting framework, a central bank could respond to that. Those were the two comments. Thank you.
Thanks, Parag. I think transmission is a very important point here, and RBI itself has been struggling over the period of time, and they have changed these rulings multiple times and how they want to improve the transmission. So I think there is definitely something over there. However, given the current setup we have, and the problem is much longer than the current post-inflation targeting period. So to answer that, yeah, it's difficult in the current setting, but yeah, I take your point on that. That is probably one of the reasons.
Shekhar, I'm just going to read out Vasanti's point because her voice is not gone. Adam, may I?
Yeah, please.
She points out that the OMOs has been going on even in 2018 and going back in time, and that FX interventions also potentially have an important role that we need to think about when we talk about conflicting objectives with the inflation targeting framework. So it may not just be post 2019, and perhaps that's something that you should consider.
Yeah, so, I mean, coming back to Vasanti's point, yeah, that's very important, but it really changed after the new governor came in. And so this again goes back to Ajay's point that, you know, de facto they're saying one thing, but then they're doing something else. And so that is,
may I suggest just look under Raghuram Rajan, there was the gigantic amount of exchange rate activity. So I don't share this narration about dates.
So we're basically out of time. Suresh, if you want to just quickly state your comment.
I'll just quickly state my comment. See, Shekhar, interesting paper. One thought that I had is that you used Picoult and Reynolds' paper as a reference. And Picoult and Reynolds really looks at bigrams, and he's distinguished between hawkish and dovish. I was wondering why you just didn't take growth and inflation references rather than take bigrams, because you're not really distinguishing between hawkish and dovish. You could just take growth and references of inflation. Thank
you. So perfectly taken. So initially when we were doing the paper, we were looking at bigrams, but then we updated the next round of paper. And so now we are using the topic modeling, although we keep the bigrams analysis in the appendix. But yeah, I think your point.
Adam, can I just 2 seconds, just a quick point? Okay.
Okay, very
So
quick.
there's also a question of institutional depth in terms of information provision, right? It may well be the case the RBI has no new information that the market doesn't have already, because there isn't the depth required to be doing the amount of research that's required for the MPC to function well. I mean, we need to keep all of these options on the table when you're discussing hypothesis. Don't take IT as a given, as though it's actually working. That's my only submission.
Great. Well,
Okay.
I'm sorry that it falls to me to call this to a close, but thank you both very much. And the comment